All right, let's continue on session one with chapter one, which is an overview of financial management and the financial environment. So the little comic strip here is we have an investment and retirement planning session where you have a consultant working with a client, and he says you have to spend money to make money. So I've bought myself a cabin cruiser, a luxury sports car, and a giant screen plasma TV. Well, that's not exactly what we mean when we talk about investments. But being wise with your money is definitely something we want to become proficient in. All right. So the learning objectives for chapter one are to understand the objectives of the firm, and that is to create value for the shareholders and employees through increasing the future cash flows. Second is look at different organizational forms. This is a fairly technical um, topic, which is important for you guys to understand, related to the differences between proprietorships, partnerships, and corporations. Third are looking at our markets, the securities that make up the markets, how the markets behave, and what are the institutions that participate and create the flow of funds in the marketplaces. And fourth is to look briefly at the subprime mortgage meltdown and the financial crisis of 2008. That occurred recently and it's still having its ripple effects on the recovery of markets and also our thinking about how securitization works and how financial markets can sometimes get out of control. So let's start with the 5-minute MBA. Probably going to do it in less than 5 minutes. So the objectives for the company are first to create value for the customers, because if you don't do that, you'll have no customers and you'll have no business. And secondarily, then to create profits and cash flow by our ability to create products and services that are demanded in the market. The key attributes you'll find in successful companies are skilled people. Without skilled people, you probably won't get very far. Second is relationship with stakeholders. Stakeholders are your customers, your suppliers, your communities, regulators, kind of influencers. These are the stakeholders in the business, broader than simply your value chain. And then your funding, what type of funding you have, the support from your shareholders, support from the debt and bondholder community. A firm's value is determined largely based on its future free cash flows. That's a fundamental aspect of how finance is built. The idea is the value today is based on the value that we can expect going into the future. A lot of people think that the value of a company is based on its past. Oh, if the company has been worth $100 in the past per share, it must be worth $100 in the future. Well, that's not true whatsoever. What makes that $100 company in the past worth 100 in the future is that it continues to do well and that the expectations are for continuation of good profits. So in a formula basis, the free cash flow equals sales revenues minus the operating costs minus the operating taxes, namely those are taxes on operating income, minus required investments to maintain the business. The number itself that's left over is what's available to distribute to the investor. So what can managers do to impact the cash flows? The amount of expected cash flows, the more you have cash flows, the better. The timing of the cash flows, the sooner the better, because money today is worth more than money 10 years from now. And the risk of cash flow, the less risk, the higher the value of that prospective flow. For example, if you buy a lotto ticket, it might be worth $10 million, but is more likely to be worth zero. So there's a high degree of risk when you buy a lotto ticket. So that's what we're looking at. These three aspects, the cash flows themselves, the timing of the cash flows, and the risk of those cash flows occurring are the three main determinants of the cash flow and valuation of a company. Another term that you will use quite a bit in finance is the weighted average cost of capital, otherwise called WACC. Each word means something in that phrase. WACC being weighted average. So the weighted average means that depending on where is your source of capital, it'd be weighted accordingly. So if a company is 90% financed by debt and only 10% by equity, well, the cost of the capital for the debt is going to be weighed quite a bit heavier than the requirement of return for the equity holder, which is only 10%. Now, What if the opposite were case? If it's 10% debt and 90% equity, well, then the weighted average cost of capital should be higher because there's more equity and they demand higher return than a lender. So weighted average cost of capital shows that for a given company and its composition of debt and equity sources, and also the required return from their providers of debt and equity, you will determine their cost. So it's affected by the capital structure, this percentage of debt versus equity. Second is the cost of that capital. In the case of debt, that's the interest rate. In the case of equity, it's the required return that the shareholders have for investing in you in the first place. And again, the risk. The higher the risk, the lower the value, or the higher the required return. All right, so we'll do a sample calculation of weighted average cost of capital. The given information in our assumptions will be the bondholders require a rate of return of 10%. That's an interest rate on the bonds. The effective tax rate, income tax rate, is 35%. Shareholders require an equity rate of return of 20%, and the firm is financed 60-40, 60% debt, 40% equity. So what is the WACC? All right, so we'll carry this into a spreadsheet. So we'll start with the cost of debt, and then we'll have cost of equity, and the amounts were 10% and 20%. So this is the required return. And let's format it. So just shade it and hit the percent. And then we have a tax rate of 35%. And let's also show that as a percent. So the net, if you will, here would be plus 10% times 1 minus the tax rate. We'll use that quite a bit, the 1 minus tax rate. And there is no adjustment necessary for equity. So now we have the net costs, and then we need the weights. And we knew this is 60%. 60% debt, 40% equity. And so the amounts all right, and we will convert all these to percentages also. So let's walk through this calculation. 10% times 1 minus 35% is 6.5% is our net cost of debt. It's lower because we have a tax shield. Cost of equity is 20%. Ratios are 60-40. 60% of 6.5 is 3.9%. 40% of 20 is 8%. And this number is our answer. The weighted average cost of capital equals 11.9%. If we use the free cash flows as the basis of valuation, then use the weighted average cost of capital for each of those cash flows. And if we add up every single cash flow from the next cash flow we're going to receive all the way to the last, or infinity in this case, the last cash flow, and we discount them back at the using the WACC, we will get today's present value, or what we call the intrinsic value of that investment or that company. So this relationship here, value equals the present value of all future cash flows, is a basic valuation approach in finance. And the breakout using free cash flows is you take free cash flow for time 1, which is a year from today, and then you divide it by 1 plus the weighted average cost of capital. The one we just did was 11.9% to the first power because it's 1 year out. Then you take the cash flow that's 2 years out, FCF2, and then divide by 1 plus WACC raised to the second power because you're waiting 1 extra year to get your money. So the longer you wait to get your money, the larger and larger that denominator becomes. And that's why we call it discounting the cash flows. All right, so that would be the generic formula for a free cash flow based method of valuation. A depiction of how this looks graphically is that the centerpiece here in blue shows what I was describing. Above it, we show how we derive the free cash flow. Sales minus operating costs and taxes minus required investments in operating capital is free cash flow. So that's how we get the numerator. The denominator, and this is something we'll learn later on in this course, and is looking at the elements that give rise to your cost of capital, which is this mixing of cost of equity and debt, which has a measure of how the market perceives your risk as a company and also the amount of risk that you're undertaking. So all those are the components that feed into the two types of information we need, the free cash flow and the weighted average cost of capital. So let's try to do a valuation. So we have cash flows of $100 million, 150, and 250. And at the end of year 3, we sell the company for $1 billion. WACC is 10%. The debt is $300 million. What's the value of the company? And what's the equity value to shareholders? So again, let's move out into Excel. 100, 150, 250. 100, 150, 250. And the sale is $1 billion. Just put it here, which is a thousand millions. The reason I put it there is this is years. These are FCFs, and this is the sales proceeds, and this is total. That equals that plus that. Copy, shift, enter. The WACC is 0.1. Now the factor, again, is plus, open parens, 1 plus the WACC. Let's lock that down with an F4. Close parens, caret is the power to the power of, and power of 1 for year 1. Okay, so let me go through that one again slowly. 1 plus the WACC, which is absolute reference, $B, $7, close parens, raised to the power of C3, which is the first power. By using references, we can now copy this formula. That's why we do it this way, rather than hard coding numbers. So copy over, and now we have the right factors. So now we can do the PVs, which is the FCF divided by the WACC. So we have these three cash flows, and the sum of those three is, this is the enterprise value, and then less debt. Debt, as we've seen, is 300 million. So that's equity value is the billion minus 300. So in this case, this company with cash flows of 150, 250, and selling it for $1 billion at year 3 with a WACC of 10% and debt of 300. The value of the overall company to all providers of capital is 1.1 billion. The value to the shareholders is $854 million. So this is a very simple example of something you'll see quite a bit in finance, which is the valuation based on future cash flows as discounted by a cost of capital. So that's a valuation. So next we're going to look at a slightly different angle, which is some complexities in running a business. This little graphic here shows what is at play here. Is that if you're the owner of the company, then your interests are aligned with yourself. In other words, you want to make money because it's your business. However, once it gets a little more complicated, namely past one person, it gets complicated in that you hire an employee, and the employee has two motivations. They want to do a good job, but they also want to make money. If the way for an employee to make money is at odds with what's best interest of the company, then we have what we call the principal agent problem, or alternatively called an agency problem, where the agent, the employee, has more incentive to do something for his or her self-interest rather than the interest of the company. And the most typical example of this is a sales commission to a salesperson. If a person is paid, let's say, 20% on the sale of a product, and let's say that the product costs $1,000. So if they sell it for $1,000, they get 20% or $200. But what if the customer says, oh, I don't want to pay $1,000. I want to pay $500. Then the salesperson says, sure, I'll sell it to you for $500 because the salesperson can still get a sale, get 20% of 500 and make $100. Now, what's the problem? The problem is if you're the owner of the company, you may be losing money if you sell that product for 500 when the list price is 1,000. So there we have a principal agent problem where the agent, the salesperson, is now given incentive to act in his or her self-interest, which is now at odds with the incentive or the interest of the owner. Now, at a slightly higher level, at corporate governance and board of directors, we have similar issues. And there we have this idea of fiduciary duty. Fiduciary duty is a legal term that means that if the shareholders elect a board of directors, every member of that board has a fiduciary duty to act on behalf of all the shareholders, not his or her personal interests. And you say, well, isn't that the same? Well, no, not at all. If the board has perks and compensation and stock options and junkets to faraway exotic places, and then now somebody comes and wants to buy the company at a very favorable price, the director might think twice. They might say, well, we're going to sell the company for a lot of money. Our shareholders would be happy. That would be fine. However, what if they say, well, we can sell the company, we make a little bit of money, but I lose my board fees, I lose my stock options, I lose my junkets and all my perks. Forget it, we'll not sell. So that's a breach of fiduciary duty, where a board member is looking out for his or her interests instead of the shareholder. So governance is how companies look at how do we govern or make rules in the company such that the best outcomes are possible. And this is a pretty tricky thing. And good design, good hiring, good practices, good culture, all these things kind of counter the natural human tendency for self-interest. So the next section deals with organizational form. And we'll look at three different types of organizations: sole proprietorships, partnerships, and corporations. The easiest is a sole proprietorship. It's your business. So you start a business and you call it ABC Co., but it's really just you. The ease of formation is very easy. You just kind of file a name that I will now do business as. That's what DBA is. Do business as ABC Co. Legal aspects, also very easy because there is no owner other than yourself. There are no contracts necessary. Regulation, pretty minimal. You still have to adhere to being an honest and law-abiding business person, but nothing special for the formation. Taxation, you're taxed as an individual right now, and if you have a company in that is your alter ego, ABC is essentially you would be taxed at your income tax rates, your individual income tax rates. So that's also very easy. Lifespan, this is a problem. You die, it's over, right? So it's completely tied to you, and of course, that goes for the life of you and the entity. Personal liability, here's the big problem: unlimited. Something goes wrong, you get sued, or somebody is damaged by your product or your service. You would then be exposed for everything you own to make good on whatever damages you cause another. Next is access to funding. It's limited because there's not as much security. It's just you. If something goes wrong, the banker or the shareholder won't be as protected as if there were more substantial borrower involved. So on the right side, we have some comments. It's your decision. It's easy. No filings are needed. Just general laws of good commercial behavior. Taxation is just your own individual tax return. And you are the company. And the obligations are personal. Even though you may have taken it out as ABC, ABC is you, so therefore it is a personal liability. And access to funding is just as if it's your money. And if you could borrow money, your entity has money. And converse is true. If you don't have access to money individually, forget about it for your sole proprietorship. Next is general partnership. On very top, I put avoid because I've gone through quite a bit of heartache and headache and financial risk in general partnerships. So they're dangerous. They're fairly common and they're easy, but they are legally very risky. So using the same attributes, formation, pretty easy. All it takes is a couple of people to agree to do business together. A handshake is almost sufficient, not advisable, but sufficient. Legal aspects, you should have a written agreement. Note the word should. Again, you could do it on a handshake, but people have a convenient loss of memory when things go awry. So write it down. Next is regulation, minimal. There is a uniform partnership set of laws, but other than that, it's fairly straightforward. Taxation, it's a little more complicated because you have more than one person owns the business, but you just split it up according to their ownership typically, and everyone takes their share and pays their taxes. And lifespan of company, it's again an issue because if there are two of you and one dies, then we have a problem, right? So this is one of the issues of partnerships is that what happens if someone passes away or otherwise leaves the partnership. And a comment here is we could mitigate it by having buy, sell, or other mechanisms in the event of a partner exiting. Personal liability, unlimited. This is why it's bad. So let's say you and three other friends form a general partnership and somebody slips and falls in your store and somebody has a customer and they sue you. Well, if you don't have adequate insurance, then the liability falls on the partnership. So that's bad because each of the partners would be responsible to make good on that damage. It gets worse. What happens if you're the only one with money? And even though you only own 25% of the company and your other three partners own 25% each for the other 75, what happens if you're sued for $10 million and nobody has money except for you? You can be held liable for all of the liability of the partnership, all the $10 million if you have it. Then you would have to sue your three partners to get back your share from them. So that's why general partnerships are very, very dangerous. That it's personal liability at all is bad news. But furthermore, for those with more assets, they're actually at more risk than those with less assets. So there's a lot of bad things to do with liability aspects of a general partnership. In other words, avoid it. Access to funding, limited. There are more people there. There's more collateral, more guarantees, more people. So it's a little bit easier than getting an individual. However, there is not as much as you would see as a corporation, which we'll see in a moment. Now, there is a way to mitigate the problem with liability, which is the main problem of partnership. So this is a little bit complicated graph. All I've carried, the first two columns are right here, and have added these four. So these two columns represent limited partnership. It's a little bit more complicated than a general partnership. And the basic idea of a limited partnership is that you have one general partner, and then all the other partners can be limited partners. And by virtue of them being limited partners, they can only lose the amount of their investment. They can't lose any more money beyond that. That's the huge advantage to a limited partner. Now, the limited partner has to behave a certain way, cannot be active in the business, cannot make major decisions, basically is a provider of money to the general partner, if you think about it that way. And therefore, the liability is limited because the degree of control in the business is limited. That's the general notion of a limited partner. But it's effective. So and these are very common in real estate. So one partner is the expertise partner who puts the whole thing together. The other people are the money partners. They put money into the real estate investment, and they could lose that amount of investment, but nothing more. If the project goes well, the general partner makes a little extra return on investment because they did more work and took more risk. But then the limited partners also make a good rate of return as well. So that's a very successful and well used way to finance a real estate investment, for example. Legal aspect, now we have to have a written agreement because you have to differentiate legally the requirements and responsibilities of the limited versus the general partner. Regulations, same as general partner, basically, partnership law. Taxation, same as general partnership, but it's basically by agreement on who gets how much of the tax attributes. Lifespan, same issue. What happens when person passes away? You have a buy-sell agreement or other ways to deal with maintaining or continuing the partnership. Personal liability, this is the big advantage. One person, the general partner, has risk. The others have protection. So it protects all but one. So that's a nice attribute. Access to funding, a little tougher because now you have fewer people to go after. So if you're a banker and you lend to a general partnership and there are four partners, you can go after any of the four. If you're a banker and you loan to a limited partnership, you can only go after the general partner. So if there's one general and three limiteds, you can only go after one. So it's quite a bit less security for the banker and therefore less attractive as a loan for the banker. The last two columns represent variations called limited liability corporations, limited liability partnerships, and these are usually used for professional corporations or professional groups, such as law firms, consulting firms, CPA firms. Very, very common form. And the difference is that they won't have a formal GP relationship. They would have managing members. The use of terms is quite different. And very similar, other than the legality of the general partner. It's cleaner for professional corporations to operate in this basis. It protects their liabilities and yet allows them to share in the profits of the business. So those are partnerships, general, limited, and limited liability partnerships. Third is corporation. This by far is the most common in the US, and it's because the commercial side of the business is geared around a corporate entity being the business itself. So again, using same attributes, ease of formation, a little more work to incorporate. You have to do filings, you have to adhere to corporate law, state law. Legal aspects, there are more documents to file, same as the ease of formation attribute. And in regulation, there's more law, again, state and local and federal for corporations. Taxation, this is the ugly one for owners because you're taxed twice. What we mean by tax twice, tax once when the corporation makes money, and then if the company distributes money to its shareholders, the shareholders are taxed again. The taxation is double, once at the income at the corporation level and again at the recipient, namely the shareholder, whether it's a dividend or it's a liquidation of the shares. Lifespan, this is a positive for a corporation. It is its own entity. It's not a person or a group of persons. It is an entity that has shareholders. So it has unlimited life. Personal liability, there's no personal liability. That is, again, one of the big advantages and why this is so popular is that in general, a person who sues the corporation cannot go after the individuals who own the company. And access to funding is improved. This is the most common form of funding for bankers, for bondholders, for investors. So this is very common ground. Now, what if we want to find a way to get around this little tax problem? around this issue of being taxed twice. We can do so because in the United States, there's a special provision in the Internal Revenue Code called Subchapter S. So a regular corporation is called a C corporation. If you're a corporation but you want to elect a Subchapter S status, you have one huge advantage. That is that you're taxed once. So rather than having taxes paid at corporate and then again when you distribute, a Subchapter S corporation will take the income earned by the corporation and distribute that and have it taxable to its shareholders. Now, the shareholder pays that tax, but will not have to pay taxes on the distribution of dividends. So therefore, it's single taxation. So the reason the IRS and actually it's US Congress put in place Subchapter S is not a loophole. It's actually an inducement or an advantage for the formation of business. If they made it too hard for companies or less advantageous for companies to form, there'd be less companies formed. So this way enables companies or individuals to form companies, grow businesses, take more risk, and shelter their own personal liabilities, and also reduce their tax burden compared to a regular corporation. So that's it. Oh, the reason it's put in place is for small business. So after a company gets a certain size or has a certain complexity of ownership, they can no longer retain its special subchapter S status. They'll have to revert or convert to a C corporation and pay more taxes, pay double taxes. But for kind of early stage or for smaller corporations, it's fine. They could stay subchapter S through their entire existence. Now, there's a new kind of corporation that is not uniformly available in the United States yet. Let's say it's about half of them. It's called a benefit corporation. And here I want to point out that there was a slight inaccuracy in the book, and I'll tell you what that means. So I call this alphabet soup. We have C Corps, S Corps, and we have something that people are tempted to call the B Corp. So a benefit corp is a for-profit corporation. However, they also have social responsibility or environmental objectives. So there's a social impact investment, and that's why it's called a benefit. It's a social benefit corporation. Now, the reason of the inaccuracy in the book is that the book takes a shorthand and calls it a B Corp. Fortunately or unfortunately, there is a copyright on the term B Corp by Certified B Corps, which is run by an organization called the B Labs. And a B Corp is a company or is a designation when you comply with certain requirements to be a social benefit corporation, or it's actually a company, social benefit company. So it's best to call them Benefit Corp or Certified B Corp. So there's no ambiguity. If you simply call it a B Corp, some may think it's a Benefit Corp, or some may think it's a Certified B. That's a little bit too complicated for most people. So just remember that when you hear B Corp or variations thereof, it's a company that's for profit, but is really formed to do something good in addition to making a lot of money for its shareholders. All right, so let's say you go from a corporation, you get larger and still need capital. So that's when we go to the public markets. And IPO is something I'm sure you've heard of, initial public offering. It's when a company changes its status from being a private company of just a few shareholders to now being available to be sold and bought every day on the exchanges. And you're now publicly owned as opposed to identified individuals that have chipped in money together to form your business. So once you're registered, the big advantage is now you have access to all capital markets. And it means you could sell more common stock, you could sell preferred stock, you could sell bonds, you could do fancy financing instruments. So it is advantageous for large companies who want to take advantage of the full suite of possibilities of financing to be a publicly traded company. Third objective is financial markets and institutions. And this is just how money flows between those who have money, the providers of capital, to those who need money, the borrowers or the users of capital. And the financial markets essentially are matchmakers to matchmake between those who have money and those who don't have money, make sure the terms fit the risk return profile sought by the investors and are on reasonable terms for the borrowers or the user of capital to pay for that. Who are these people? Households in general are net savers. We in the US tend to be more borrowers than savers, but let's just say in aggregate, we're net savers. The non-financial corporations are net users. So most corporations use capital to grow their businesses. Governments, hate to say it, are net borrowers because U.S. government is in constant deficit the last 10 to 20 years. And because of that, the U.S. government is burying itself in more and more debt. Financial corporations, they're slightly net borrowers, but almost break even. Financial corporations are banks, insurance companies, and they manage their cost of funds very, very carefully. And they tend to seek lower cost of funds, such as CDs or passbook accounts if you're a bank, and policies or other insurance payments into a fund if you're an insurance company. So financial intermediates and institutions make all this happen. So here's a graphical depiction of how it looks. So we have three types of transactions. Some are direct transfers from those who have money to those who need money. The second are indirect through an intermediary, in this case, an investment banking. And the third is indirect by use of a financial intermediary that's not an investment bank. So going through each of them in turn, if there is a business that needs money, they could get money directly from a source by issuing commercial paper. By this I mean General Electric can issue in its own name commercial paper saying, I will pay you back $1 million. And people would buy it. Maybe not you or me, but some institutional investors, savvy investors, would be happy to have GE owe them $1 million. So that's commercial paper. The second is investment banking. So investment bankers sit in between people that have money and people that need money. So they are the ones that arrange the IPO through the markets and the SEC. They also arrange debt, whether that's public debt like bonds or even private debt in many smaller or kind of more specific transactions. So investment bankers are very active in capital market and financing generally. And then we have more traditional financial intermediaries like banks who could be issuing a CD. So the saver may get a CD from the bank, which is essentially loaning money to the bank at a fixed rate of return. The bank in turn is now open for business and lends money to a business, or I guess it could be individuals too if it's a bank, for a higher interest rate. So if it pays you 1% on your CD and it loans it at 7% for a car loan, that spread is the amount that will go toward covering the overhead and profit of the bank. That's how banks exist. So cost of money for investors. For debt, as we saw earlier with the WACC example, debt is the interest rate, right? The cost of debt is interest rate. Cost of equity is what is the return that a shareholder gets, and it equals the dividend yield plus the capital gain. Capital gain is how much did your investment go up, hopefully, in value. So if you bought something, a share of stock for $10, and every year you got $1 in dividends, you got some return, 10% return, by a dividend yield. But that's not why you bought that stock. You bought that stock because you think it's going to go from 10 to 15 to 20. So your components of return are dividends and capital gain. The types of securities, we've already talked about these. Debt is loans that we normally, when we say debt, we normally mean debt from a bank or a financial intermediary. But debt can also be a bond. So if it's a capital market security, a bond, then it is again a loan with a certain regulatory process and terms. And then there's a money market security. These are these shorter term instruments. We talked about one earlier with the GE example with commercial paper. Equity, stock, and it's called residual claims, which means you get the leftovers. Now, if a company does very, very well and it liquidates, it's going to pay off its bills, pay off all the people they owe money to, and have a lot of money left over. So if you're the residual owner of Apple or Google, you're feeling very good. However, what if you're a residual owner of a company that's struggling and not doing well at all? By the time you pay off all the people that you owe money to and all your bankers and all your bondholders, you may be left with little or nothing. So if you're common shareholders, you may have high upside, like if you hit it well with Google or Apple, or it could be not doing so well if you buy a company that's struggling or going out of business. So that's why equity has higher risk and therefore demands and should demand higher returns. Derivatives are a type of security, which, and the name kind of tells you what it is. The value of a derivative is derived from something else. And so it could be something that's a physical commodity. An example could be jet fuel or corn or orange juice. Or it could be something that we have a traded value, such as foreign currency or the value of the stock market. So derivatives can be based on anything that is ascertainable in value, but not right now. There's a time component to derivatives. And the reason these complicated instruments exist is that they're very useful in controlling or minimizing uncontrollable risk. So if you're an airline like Southwest Airline, you're really at the mercy of the fuel markets on what jet fuel would be. So if you're out there selling tickets to fly from SFO to New York a year out and the jet fuel prices go up, now you're exposed. So what hedging allows you to do is you use derivatives to buy jet fuel out a year from now so that you're not exposed to the whims of the jet fuel markets. And that's how it's used. Derivatives are used to reduce the risk for things that are uncontrollable, like jet fuel for Southwest Airline, or flour for a baker, or sugar for a candy maker. So a related topic is securitization. Securitization may seem like a bad word these days because of the debacle in 2008, but it's basically a set of assets, typically loans or receivables, that you bundle together and sell in a large chunk to the capital markets. And it takes something that's very illiquid and it creates liquidity. And liquidity is just cash, right? So if you sell cars, if you're Ford Motor Company, and you're selling a lot of cars on 3 and 5 year leases, it's great. You sold a bunch of cars. However, you didn't get the cash. All you got is paper from all these individuals that bought cars. What if you took the stack of all those loans and you sold them in a big block and get $200 million for your stack of car loans? Now you're talking, right? You sold the cars and you don't have to wait 3 to 5 years to get your money. You can bundle it, sell it at a slight discount to the bondholders, and you got cash. So that's why securitization is so powerful. It allows companies to gain liquidity and put money back into their business and churn through and generate more money. So that's the beauty of securitization. There are also a lot of risk and abuses, but in its abstract form, it's a perfectly okay thing to do. Not just okay, it's a perfectly good thing to do. So what are the 4 factors that affect the cost of money? There's what are the opportunities that exist for you or to you? What is the time preference for consumption? Do you need it now? Do you want it next year, etc.? and the risk of the investment. Again, the higher the risk, the more return that will be demanded by the provider of capital. And what's the inflation rate? And that's because money today is worth less a year or 5 years from now, but it's even worse if the overall price level goes up over that time. Then not only must you compensate the provider of capital for the yield, the real return, if they as they call it, but you also cover their inflation because you can't have the provider of capital go backwards by lending you money. So they will require the inflation plus a real return on their investment in you. All right, what is the economic side of this? Well, we have domestically the Federal Reserve, which sets policy related to the money supply. We have the federal budget deficits and surpluses. We haven't had a surplus in a while. We're now in trillion-dollar land for budget deficits. And then level of business activity. Are we now in a recession where there's not a lot of business activity? Are we in a boom time where companies are being formed, companies are expanding? What is the demand for money because of business activity? And how about the international picture? Deficits and surpluses. Again, U.S. has been in a trade deficit also for the recent past. International, there's economic risk of the company, there's geopolitical risk in different regions. So there's, in addition to all the other things that happen in a domestic basis, international adds on multiple more layers of complexity and risk. Exchange exchange rate is countries now move against each other in terms of their strength and weakness. So we'll undoubtedly see continued adjustments in the exchange rates between the yuan in China and the other currencies as China moves to less of a controlled exchange rate and unpegs their rate. It will have dramatic effect on exchange rates. This slide I'm not going to read to you. It's in your textbook. But on the left-hand column, you'll see all the variety of instruments that comprise the financial offerings of all these different intermediaries. Intermediaries as in banks, intermediaries as in the capital markets and the bond markets. And you can look at this in your own leisure on this slide or in the book. This is lifted straight as an exhibit from the book, but it shows much of the terms that you're likely to see in your business lives, particularly the left column. And so it describes who are the issuances or who is involved in each of those. What is the level of risk of that particular investment? What is the maturity of these investments? And some are very, very short. As we mentioned, some commercial papers could be a day or even a week, and rates of return. So again, different risk and different return. Institutions, in the security side, there are investment banks, and these are people who do the large transactions, such as Goldman Sachs or Morgan Stanley. These are the big names in investment banks. Then there's securities brokers who transact in the secondary markets, after the IPO. So Charles Schwab is a large securities broker that does a lot of work with individual and institutional investors, but they transact trades after the IPO. Deposit-taking financial intermediaries, these could be commercial banks such as Citibank, or they could be a whole host of variations of mutual savings banks, savings and loans, credit unions. Tend to be quite a bit smaller and more narrow in scope than a bank, but they nonetheless serve an important role in being depository institutions in the US. Investment funds, such as mutual funds, where they manage portfolios on behalf of their clients, such as Franklin Templeton, or a new approach to investment is called an ETF, exchange traded fund, where you're putting blocks of money together, and rather than picking stocks, they're mirroring a certain index. So as the index moves, your investment will also move. The most common and the initial one that started this whole thing off was a SPDR, which is a Standard & Poor's 500 index. So if you buy a SPDR, your rate of return will match the market. So it's popular because people feel that it's difficult to be a very good stock picker these days with all the sophistication in the pricing of securities. Life insurance companies, John Hancock Mutual Life is just one, but they are large financial institutions where dollars are put into those companies. They invest them, and then when catastrophic events occurred, or just the event of the company itself, like an individual policyholder dies, they pay a claim, right? But in the meantime, they're using the money to make investments. So insurance companies are actually very, very large investors, even though they're investing because they are trying to grow the value of the pools of money that were meant to just share risk by insurance. Pension plans, such as the California Public Employees Retirement Fund, CalPERS is a very large pension fund, and they have widely diverse holdings, stocks and bonds and real estate and all types of different categories of investments. And finally, hedge funds. These are Soros or Bain Capital, also could be venture capitalists such as Kleiner Perkins. These are private investment pools that are very risky relative to, say, an insurance company, but they also have very strong investors in those companies that are very sharp at their areas of investment. So a hedge fund could be very good at spotting opportunities in the marketplace. A private equity firm may be very smart at taking segments of a large company private and buying them away from the mothership, fixing them up and selling them. Or venture capital, as you probably know, invest in startup companies and hope that they are the next breakthrough company in the stock markets. So what are some of the types of markets? So again, this is more general education about how terminology and markets work. So market is basically exchanging one asset for another, right? So a market could be going to a flea market or going to a farmer's market, or it could be something very sophisticated like a stock market or a bond market. But it's basically a place or a mechanism to exchange assets. They could be physical assets, such as we mentioned, fruits at a farmer's market, to financial assets, stocks, bonds, derivatives, things of that sort. Spot versus futures. So these relate to commodities and also derivative type of investments. Let's stick with commodities. So a spot is what is the current rate. So if you're buying a barrel of crude oil, the spot rate means what is the price trading today. A futures is what is the price trading, say, 30, 60, 90 days from now. So that's the difference between spot and future. It's the time dimension. Money markets deal with paper, commercial paper, monetary assets versus capital markets, which are bonds with durations of more than 1 year. Primary markets are where we have new securities like an IPO versus secondary markets where after a company's gone public, the person that first bought the stock now wants to sell it. That's considered a secondary market. So after the first issuance, it goes from a primary or an IPO to a secondary market. So the major securities markets in the US are New York Stock Exchange. That's the picture on the right with real live people doing trades. And the other is NASDAQ, which is smaller but gaining in prominence every year because they're easier to go public, and companies have found that they can stay in NASDAQ and do perfectly well and don't need to graduate to NYSE. So companies such as Intel, Microsoft, and Cisco went public in NASDAQ and saw no need to go to the NYSE. That's why NASDAQ is growing, because in the past it was just the entry point and everyone wanted to graduate to the NYSE. Now NASDAQ itself is a legitimate market, even for some of the most successful companies in the world. Indices. So many of you have heard of the Dow Jones Industrial Average, or the Dow, or the Dow Jones. And this is a dollar-weighted index of 30 stocks that comprise a disproportionate share, around 20% of the market value of U.S. stock. So it's amazing the level of concentration in these companies. But it's still only 30 stocks. The second is the Standard & Poor's 500. which is valuated and it's across some of the largest companies in the US. Generally considered a better measure because it has a broader base and it's also valuated. The NASDAQ composite is a view of smaller companies, growth companies. And so use different indices based on your purpose, your analytical purpose. We talked a little about ETFs, and it tracks the index. It's not actually an index. The long-term results of S&P, and that's what this is, shows that there are very distinct cycles that you can see pretty prominently. We see this last dip, which we'll explore a little bit later. This is the most recent recession due to the debacle of the mortgage crisis in 2008. And so over time, this is why people say investing in stocks is a good investment, because you can see over time, and this dates back to 68, that there's a pretty steady rise in the valuation of stocks over a long period of time. So I'm going to touch briefly on the story of the subprime meltdown. Many of you may already know the story, but I'll give some of the drivers. So mortgage rates were going down and the real estate prices were going up. So what people did was they bought houses, whether or not they lived in them, because they felt that if they bought a house and sat on it, that the value of the house would go up and they would make money. That kind of speculation and frankly greed caused the overheating of the residential markets in the late 2000s. It takes more than one person to make this debacle occur, and I like to think of it as unchecked self-interest from multiple people up and down the entire ladder caused this crisis. So, and not, I don't want to paint these guys out to be like crooked people. This is like a nice young family trying to buy a house. Now they can afford a nice 2-bedroom condo, but they're tempted to buy a 4-bedroom, 3,000-foot house because they can get a cheap mortgage and they have an expectation of that if they stay there a couple of years, they're going to make all this money on this house, right? But they are basically just needing a housing for three of them. So they have a little bit of incentive and a little bit of greed to try to make money on the house. This person is the real estate agent. So if she sells a house, she'll make some percentage of the sales price of the house. Let's call it 7%. So if she sells a condo for a couple $100,000, she makes 7% of a couple $100,000. If she sells $1 million house, she makes 7% of $1 million. So she has incentive for selling more house to the buyer than they want, need, or prudently should buy. So they both have now incentive to buy more house than they maybe prudently should buy. This next person is the loan broker who has to make a loan to support the family to buy that expensive house. Loan brokers, same thing. The higher the loan, the more their fees. So they have incentive to give a higher and higher mortgage. Even if you don't need the mortgage, they want to sell you the mortgage. If you can qualify for a bigger house, they want you to buy a bigger house so they get a bigger fee. This person is the appraiser. The appraiser has incentive to keep appraising the numbers based on this crazy market, even though it may not be a long-term smart investment. They give an appraiser that conforms with the loan that supports this buying of this house. This person is the warehouser who gathers all the loans ready to sell it to the markets. This is just paper that loans that can last 30 years. So this person works with the investment banker over here, who then sells it to the markets. So they take the big stack of paper and converts it to cash. There's an insurance company that's trying to create some insurance products to support the mortgages and their defaults. The next one are the investors, institutional investors, who are always seeking a slightly better return for little or no increase in risk. So they're buying mortgages because they think mortgages are always safe. They're not always safe, but they thought they were. and rating agencies who put a stamp on the on this pile of securities saying that they're safe loans, and they're paid a fee for that opinion, and they know that if they give a contrary opinion they may not get the job, so they now have a disincentive for actually being critical of the creditworthiness of that stack of mortgages. Then you have the US government, which enables all this to happen, in some ways likes to see wide home ownership, and have federal agencies, Fannie Mae, Freddie Mac, that are involved in the mortgage business to kind of make this whole thing work. So every one of these steps has people that are part of having this couple buy more house than they should, taking on a bigger mortgage than they should, which creates a bubble. And then the bubble collapses. And that's exactly what happened. So this rise that we saw through the 2000s up to 2008 collapses abruptly. And we see foreclosures, bankruptcies, repossessions, just a very, very ugly thing. So, and many of the more venerable institutions, I don't know if they're all good institutions, but many of them either went out of business or had their wings severely clipped. Bear Stearns and Lehman both went out of business. AIG insured a lot of these very fancy credit default agreements. They needed a bailout. B of A bailed out the largest underwriter of loans in the United States countrywide. Fannie Mae and Freddie Mac sustained massive losses, again propped up by the government. And GM declares bankruptcy, and it gets propped up again by the US government. So it was a very scary time for the American economy, which created a very scary time for the global economy. Regulation world, more leaders and businesses fought to restore controls and normalcy to the markets, and took some pretty severe actions, some of them controversial, to stabilize the bleed on the banks and the failures of banks, and propped up much of this to make sure that there wouldn't be even a wider issue. And there were some reforms on the practices that hopefully will avert this from happening. The economy itself is part of a cycle. So we're looking back to 1920s and see all the economic cycles here. And we have this dip right here in this gray portion, which is the financial crisis 2008, and we've come roaring back. In fact, the stock markets are close to all-time highs in the recent days. So we've come way back from a very, very depressed period to record high valuations. So summarizing chapter 1, the objective of business management, increase value of their firms. We often measure that through the use of future free cash flows and weighted average cost of capital to derive a financial value. And there are many forms of forming a business, starting with the simplest, which is sole proprietorship, going to a partnership, which could be general or limited, and to corporations, which could be a regular C corporation, a subchapter S corporation, or a benefit corporation. And then financial markets and institutions create securities that then serve to efficiently move money around from those who have money to invest, who are sources of debt or equity, to the users of capital, corporations or individuals. And the subprime mortgage meltdown led to the crisis of 2008, which was catastrophic, but we've recovered largely after 8 years from that horrific experience. So that's the end of chapter 1, and we'll have one more video covering chapter 2, and we'll be caught up with our session 1 topics. Thank you.